Thanks for joining us for another MyWealth webinar. My name is Jeff Hunter. I'm a portfolio manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line are our lead investment advisors, Dave Townshend and Raheem Somani. For more information about our team and our process, please visit mywealthmanager.ca. Today we have Vision Capital. They're going to be talking about how to buy real estate with public securities and buying it cheaper in the public markets than the private markets. They are exceptional at what they do, and they're one of the few globally who specialize in this. With that, I will pass it over for Darren for the introductions of the team.
Thanks, Jeff. Appreciate that. Appreciate the partnership and appreciate everyone joining us today. I'm happy to have Jeff Olin, who is President, CEO, and co-portfolio manager, as well as founder of Vision Capital, here to present with us today, as my colleague Brett Farquharson. So with that, I will turn it over to Jeff.
Thanks very much, and thanks all for attending. Just to give you a bit of a roadmap for the discussion, we're going to give you sort of an update to those of you assuming that you don't know anything about what a vision is, what we do. Those of you that may be clients of Jeff's that are invested with us, we don't assume you remember exactly what we do, so it'll be a refresher. Give you a bit of an update in terms of the performance of the fund in 2023. And then talk about some of the themes that are certainly relevant on a longer term basis, as well as our outlook and positioning in terms of the current market environment. So what we do, as you know, we are focused on real estate. However, unlike pension funds or REITs or entrepreneurs that focus on direct property investment, bricks and mortar, notwithstanding my background doing that, some of our team members, what we do at Vision is we're focused on publicly traded real estate securities, REITs, and real estate operating corporations. We operate both long and short. So our strategy is not reliant on being bulls for real estate. We seek to outperform irrespective of real estate supply and demand fundamentals or valuations. We seek, where relevant and appropriate, to be active, value-add, strategic investors. We don't seek to be hostile. It can take you 30 years to build a relationship. You can lose it in one day. But if we can marry our real estate industry experience with our capital market expertise and relationships to add value to our underlying investments, we look to do that. So the Vision funds have benefited from 21 takeovers in our portfolio holdings in the last 16 years at an average premium of 28% to where the takeover price was relative to where it was trading at in the stock market the day before the announcement. We have flexibility within limits to invest globally, heretofore, but for a couple of exceptions that were driven by Canadian relationships that gave us an edge in Europe. We stick to North America because we want to be hands-on. We want to tour the real estate. We want to understand the local market and competitive conditions. And frankly, it's a mistake to think we'll be any good at that in Brussels or Beijing. But the core of what we do and the raison d'etre that we exist is to take advantage of certain inefficiencies in our space. And I'm not going to spend a lot of time in this session talking about them, but you can speak to Jeff, or we can have one-on-one session if you want to know about the details there. But the result of those efficiencies is that we seek to buy real estate cheaper in the stock market than one can in the property market. We manage about $950 million. Our investor base is a mix of institutional pension fund, retail, family office investors. And we're the exclusive REIT alternative fund for JP Morgan's wealth management platform in the United States. Number of advantages as to what we do relative to what I used to do are those that buy real estate directly in property markets through bricks and mortar. Number one, by definition, you cannot buy real estate cheaper in the property market than the property market. Why do we need to be the 17th guy to compete against a pension fund, a REIT, an entrepreneur with too much money in his or her genes to buy property in an auction hosted by CBRE or Colliers, when we can buy real estate at 80, 70, 60 cents on the dollar in the stock market, have professional management, have corporate governance, have transparency, get geographic diversification. You might be the best apartment guy in Calgary. Doesn't mean you know anything about apartments in Montreal or industrial or Chicago or retail in New York City. So get property type diversification. Get access to best-in-class properties. They may not be available at all in the property market. Even if they are, an institution or a family office might have to allocate too much capital to buy that one-off property. Nobody calls us in the middle of the night to fix the heater. And we have liquidity. And when liquidity is always paramount, it's years like, March 2020, or when Brexit came to the forefront, or February 2024, where liquidity takes on a different dimension. In Brexit, it was multi-billion-dollar property funds, Standard Life Insurance, Aviva Insurance, and they promised their investors liquidity by way of redemptions on a monthly basis. And then Brexit came along and they put up gates, and they just said, what do you mean gates? I just read the offering memorandum. It says I can redeem monthly. And they said, don't you know we own office buildings and shopping malls in London, England? And as most of you know, and certainly your team at Canaccord Genuity knows, anytime you have a mismatch between the underlying liquidity of what you're investing in and the liquidity you promise your investors, those are accidents waiting to happen. And we got a lot of accidents happening globally right now. And it's not just what you read in the Wall Street Journal last year about Blackstone's B-REIT, it's Starwood REIT, it's KKR private REIT, it's in Canada, Hazelview has put up gates, you have Romspen putting up gates. But the opposite is true. If the fundamentals are negative or deteriorating or valuations are just too high, you can't do anything about that in the property market. You own a shopping mall in suburban Pennsylvania, you lose your Sears, turn out the lights before you leave the parking lot. If you own an office building in Calgary, Alberta, Canada, in our view, going back about 5-6 years now, it's going to be 15 years before you had a chance to recover your capital invested. You can't do anything about that. We can, in both of those circumstances, did do something about it by being short. I don't know how much this, Darren, you want me to go through, but the inefficiencies are prevalent. They're different in Canada, United States, but in both markets, they're significant. There's a lot of groupthink. There's a lot of momentum trading. In the US, they have the REIT mafia that tends they're required to own stocks in the index, so they might be overweight or underweight. If we don't like something, we're not going to be underweight. We're not going to own it. We're going to be short. And this is something that if you're interested, we can dive into. It is really the secret sauce as to why we exist. We launched our fund July 2008. That was not a fun period of time. And then little do we know is about the befalls in the fall of 08. But we persisted. We prevailed. At the end of January, the funds are up over 400% since inception, net of all fees and expenses, which equates to about 11% compounded annually. A couple things about this. We use no long side leverage. We don't buy stocks on margin. No currency gains or losses in the numbers. You can see it compares quite favorably to Canadian and US REITs, to the private property indices in the middle there, to the broad stock market S&P TSX index, and global and Canadian hedge fund indices. Our benchmark, which was originally created by Bank of America and adopted by JP Morgan, is a blend of the Canadian US REIT indices and the global and Canadian hedge fund indices, and we're about double that benchmark. And this, in our view, is probably the most important slide in our presentation. The absolute returns are obviously good, if not compelling. But where we really stand out is our risk-adjusted returns. We don't seek to be the best performing fund in North America. We would like to be the very best risk-adjusted performing fund And you see this on the slide. I don't know if any of these metrics mean anything to you, but certainly Dave and Jeff, Raheem know about all of this stuff. The measures of risk. Real simple one I'll mention is the middle of the page, up market, down market capture ratios. If you look at all of our returns since our inception on a monthly basis, during months when the stock market was up, in months when the stock market was down, how did we do on average in up months, and how did we do on average in down months? Well, up market ratio is pretty good, 62%. We're a long short fund. We don't use leverage, so we never have full exposure to the market. But our down market capture ratio is only 13%, a 4.6 times up market to down market capture ratio. Low correlations to broad markets, to the REIT index. And it's notable, you know, I translate this into one thing: don't lose money. If you don't lose money over the longer term, you'll probably do pretty well. And if you note that 5 of the last 10 years, 2013, 15, 18, 20, when REIT indices or the broad market was negative, we posted positive returns. And that, I think, is really the key to Vision, is not losing money is the best way to, on a long-term basis, generate outperformance. Let's give you a bit of an update. Most recently, 2023 was a solid year for us. We generated an absolute return of about 12%. So you can see how we've done on an absolute basis to the equal weight US and Canadian REITs, or our benchmark. So significant outperformance on an absolute basis. If you look at the x-axis there, you'll also see we're delivering these with significantly less volatility than the indices as a whole, which are supposedly, well, not supposedly, they are less volatile than the underlying stocks within the index, and our volatility is well lower than those. And I think it's interesting that we delivered those returns with the lowest net market exposure we've had in 16 years. So a couple definitions for you. Gross exposure is the sum of our long positions and our short positions. So if we have $100 to invest, if we invest $90 long and $40 short, our gross exposure is 90 plus 40, 130. Net exposure, which is depicted on this chart, is our long positions minus our short positions. So using the same example, 90 minus 40, which would be 50%. Our average daily net exposure in 2023 was 20%. Really for 2 reasons. One, we demonstrated to ourselves in 2021 that our strategy could be quite effective with a low net exposure. And that year we were, I think, 35%, and we delivered returns between 20 and 25%. So it gave us some confidence that it can work well. But also we had and have a very cautious outlook. Most of last year we were underwriting our base case as a recession, and it seemed appropriate for both of those reasons. We have a low net exposure. So how do you generate 12% absolute returns with only 20% market exposure? And here's the answer. Here's the performance in 2023 of 16 different property sectors. And you see a huge variation in performance. We love the volatility. When a rising tide is lifting all boats, it's harder for guys like us to differentiate ourselves. We're long, short fund, we don't lose leverage. But when you see variation and volatility, which you typically do, and we'll see that in a moment, stock picking matters more. And the first 10 months of 2023, before markets started to recover significantly, it was the only 10 months in our 16 years where we had positive attribution at the same time from our long positions and our short positions and our paired trades. That's quite unusual, and it's because of this construct you see. Now, it's not unusual on a long-term basis, and really one of the reasons we launched our fund is if you look over the last 20 years, the differential in performance between the best performing REIT quartile and the worst performing REIT quartile, the average differential was 49%. So if there was ever a sector that seemed to warrant a more active approach, real estate would seem to be amongst it. I mentioned a minute ago, our base case last year anticipated a recession. And I don't know if we're in a recession or we're going to have a recession or a hard landing or soft landing. It certainly looks in Canada much worse than it does in the United States. In fact, we're pretty close to 2 quarters of negative growth, which is a technical definition of recession. So the billion-dollar question we posed last year, well, how do REITs do in a recession? And we looked at the last 35 years, there's been 6 recessions. And what we found was, during the recession, the REIT index was up 15.9% annualized, and the Russell 1000 equities 15.3%, and private property up 60 basis points. And in the 12 months after the recession, the REIT index was up 22.7%, the Russell 1000 equities 8.2%, and private property 5.2%. So I don't know if we're going to be in a recession, but it looks like a pretty reasonable place to be if we are. Now, I mentioned earlier about private versus public. And this relationship is interesting because of over short periods of time, first 6 months of 2022, when you have rapid deterioration in markets, short periods of time, big stress, over short periods of time, REITs can perform like stocks. There's a significant positive correlation between REITs and the stock market and private real estate in short periods of time. But over longer periods of time, REITs perform like real estate, as they should. So you see in the top chart, you see public real estate securities in the dark blue line, and privately listed real estate or private real estate holdings funds in the light gray line. And you'll see the trend lines are the same. But you see periods of time where there's big gyrations, where the REIT's above and below the line. And that's precisely the opportunity that exists with our strategy, particularly with a more active strategy. So where are we today? Well, we haven't got the fourth quarter numbers in yet, but as the end of third quarter, there was a 216 basis point spread between the cap rates implied by REITs and the appraisals of private real estate. So you see in the bottom chart there, 6.5% applied cap rates by REITs, where transactions were anticipating or indicating 4.76%, this is across all sectors, and appraisals about 4.3%. So you continue to see that disconnect. Now in the stock market, REITs haven't, Vision's done reasonably well, but REITs are still the worst performing sector. There's been no recovery in REITs, worst performing sector in the S&P 500 since 2022. That's interesting. That's a pretty good setup. So our outlook, we're pretty constructive today, much more so than we've been. I mean, we think interest rates are overplayed in terms of the importance to real estate. Our blood is supply and demand. Supply and demand always trumps interest rates, always. I don't care if rates are going up or down. You got too many office buildings being built in Calgary, and interest rates have been going down. Valuation of Calgary office buildings is going down, not up, in a declining interest rate environment. Same thing when rates are going up. You got to ask yourself why. But it's a factor. It's certainly a factor on a long-term basis in terms of cap rates. And last year, a lot of headwinds to our strategy. You know, you had the fastest increase in the interest rate cycle in the last 35 years. Well, now this is tailwinds. And you see the Fed dot plot here. Projections are by the Fed based on the dot plot, about 75 basis point decline in interest rates through 2024, another 100 basis point reduction in 2025. And the more important thing and why we got more constructive and increased our net exposure is it's pretty clear that interest rate increases are over. And so that's now tailwinds, as I said. And that might be the Fed. Well, the market's saying the Fed is way too low. Bloomberg consensus expects 125 basis points cuts in 2024, which is nearly double the dot plot. In fact, precedent is in the market itself. When you look at the last 10 rate hike cycles from 1970, the median period that reached stated its peak was only 3 months, and the longest distance 15 months. And when it began to cut, it cut by an average of 260 basis points in the first 12 months and 410 basis points in the first 24 months. So these certainly are tailwinds to the strategy. And stabilizing borrow costs, again, has historically, it's been a pretty good time to be in REITs. And you see in what the 1 quarter, 2 quarter, 4 quarters. In the 4 quarters after the conclusion of a Fed rate tightening cycle, REITs delivered a 21% total return, significantly exceeding that of private real estate as well as the stock market more broadly. You know, one of the other huge advantages in public REITs is they're way more conservative than private REITs, private equity funds, or how entrepreneurs, frankly, manage their real estate. And so, you know, when I worked in real estate too many years ago, you know, the public REITs, or they weren't REITs, but they were, you know, Trizac, Cadillac, Fairview, Bramalea, who I worked for, Olympia, New York, they operated maybe 1.1 times interest ratio, maybe. The transformation of ownership to REIT and pension fund hands have resulted in much more conservative balance sheets. Today, while private equity operates at 60-70% loan to value, REITs on average 36%. Interest coverage ratios 4.5 to 1. 90% fixed rate debt with a weighted average term of 7 years. We're going to see distress in private markets and real estate. No question about that. You're starting to see it. Brookfield giving back the keys to landlords in Los Angeles. Blackstone giving back the keys. But there ain't going to be any distress in public REITs because of the conservative balance sheets that they have. They will be beneficiaries because of their balance sheet. And one of the advantages they have, besides their conservatively managed, this is strategic, but they have another arrow in the quiver that pension funds and private equity funds and private real estate investors don't have. The access of unsecured bonds. Over 3/4 of total REIT debt is unsecured. 85% of the REIT universe is investment grade rating, which allows them to access unsecured debt. And this is a huge advantage. The decline in bond yields, recent public REIT unsecured debt issuances have been 150 basis points cheaper than mortgage debt. And we've seen credit markets have been wide open. I mean, 2023, I don't think it was a record, but in 2024, in the first few weeks in January, you said a tremendous amount of accessing credit markets by REITs through unsecured debt. What are we looking at? I mean, not everything is created equal, and our job is to identify those sectors where you're going to see earning growth. And, you know, I'm not going to delve into this, but again, you see that bifurcation in terms of earnings growth, and this is what drives net asset value growth. You know, money flow. You know, why did REITs underperform so well? Because everybody was hitting the exit button. You saw 7 straight months of net outflows from REITs by investors. And you saw the lowest exposure to REITs we've seen since the great financial crisis. And so today, you see in the bottom chart, significantly low, like 6th percentile of ownership of where relative to where they typically are in terms of benchmark. This is extremely favorable. When you're so underweight and you have tailwinds, this is a bullish indicator. And when these folks start to put money to work, and we've started to see it already, both the REIT dedicated and generalists, this bodes well in terms of money flow. I mean, we talk about supply and demand as being our blood in terms of looking at real estate. Supply and demand of stocks also drive stock prices. And when you have the lowest underweight, really, it's a very bullish indicator. Again, in contrast, let's go back, Darren, a couple of slides. I think it's important right here. Well, public markets, REITs are underway. The contrast is there's a record amount of dry powder sitting with the Blackstones and Brookfields and private equity funds fully funded, $402 billion, fully funded dry powder to buy properties. And we've already seen this start to deploy. I mean, about 3 weeks ago now, Blackstone announced they're buying one of our core holdings, Tricon, 30% premium. They were traded the day before. Again, this is the 21st takeover of a holding in our funds. And so this is significant. This is the difference that the stock market doesn't appreciate in terms of one efficiencies, is often the cheapest, most effective way to buy property is buying an entire REIT. Blackstone's figured it out. They bought 50 REITs since they launched a real estate group. One of our advisors in the US called us up, called Darren up last quarter and said, you guys are kind of like the farm team for Blackstone. I think it's a compliment. Let's move on. So here's our positioning today. We were always pretty focused. We're more focused perhaps than we've been in a long time on the long side. We like data centers. We shied away from data centers for a long time, primarily because, well, the external growth was compelling. The organic internal growth was negative. When these racks renewed with the Amazons and Microsofts and Googles, they actually got a decline in the rents that they were charging because there was so much supply. Well, we've had an existential shift there. It's always been known that power is a key driver for access to power. A lot of it on a predictable basis is a key factor for data centers. In the last 18 months, we've had regions put moratoriums on new data centers. Virginia, for example, which is like 35% market share, has put a moratorium. And so now, for the first time, not only do you have external growth, you have organic internal growth, where every quarter you're seeing uplifts in that sector. The growth from AI coming is, it's hard to build these fast enough, frankly. Industrial, some might say old news. We don't think it's old news. We think it's current news, particularly with the somewhat of a setback in stock markets where there's better entry points. There's secular demand drivers that were not here last time there was a recession, where you have e-commerce wasn't relevant last time there was recession. That's a game changer. Everybody understands that now. You have onshoring and nearshoring, a result both of the revelation from things like pandemics that create supply chain shortages, global strife and turmoil, people not wanting to rely on China. Do any of us want to not rely on China for pharmaceuticals? I don't think so. So these are factors that are long-term secular demand drivers, and supply and demand is pretty favorable. We like manufactured housing communities. One of the reasons Vision typically does pretty well coming out of broad REIT sector drawdowns is sectors that we love and stocks within sectors that we love, but we don't own them because they're too expensive, and they get reset. So manufactured housing communities is maybe the poster child for this, what I'm talking about. Where maybe the best property fundamentals in the last 50 years, to give you a sense of what the business is. You know, Jeff goes and spends $200,000 of his money to buy a prefabricated manufactured house. He puts it on their land. They charge him land rent, $300 a month. Jeff pays the property taxes. Jeff pays the operating expenses. It's the most pure form of cash flow in the real estate space. Institutions didn't get it for 30 years. They got it the last 20 years. This sector's never had 12 months of declining net operating income ever, including the Great Recession. And as a result, it typically trades at a big premium to net asset value. Well, May 2022, November 2022, December 2023, we're buying into the very best names in the sector at a discount to net asset value. We sleep well at night knowing we have exposure to the sector in a tough economic environment. Single family rental homes, we talked about Tricon, that business looks pretty good. Home builders, we typically don't own home builders, very volatile sector, very macro driven. But when you have interest rates in the United States that are driven mortgage costs way higher, and you have 30-year mortgages, if you want to buy a new house and walk away from your mortgage, you're looking at a significant increase in your ability to afford your home. And so existing home sales have really gone down. People are locked into their existing home because they're locked into their existing mortgage. As a result, new home sales have really done well, and the public home builders, to deal with the rising interest rate, they've been doing buy downs. So they've been impinging on their margins by maybe 2%, 3%, still keeping over 20% to finance the buy downs on the mortgage to encourage home buildings. And home building looks really strong and really was lagged for 10 years. And our biggest weight in the long side is the necessity-based grocery store anchored shopping centers. In particular, we've been public that the best grocery portfolio in the world is reflected in the units of First Capital REIT. We've been active on the name, and we presented this recently at an investor conference, and Jeff can send you this information if you're interested. Short, excuse me. We were the most bearish guys on the planet in office. The top 5 attributions to our fund in 22 were all shorts, the office space. We've covered a lot of those. Still see pain in the private market. Stock market is really taking a hit, so you got to be more cautious at this level. We're cautious on apartments globally, primarily because of global tail risk, where, you know, politically there's populist governments that I think commendably say that all humans should be entitled to an affordable place to live. Hard to argue with that. But the solutions are draconian. 0 rent increase attempts in Berlin, Ireland, Netherlands, rent controls in Canada. Number 1. Number 2, it's a gross rent business. Unlike office, retail, industrial, where they're net rents, and the tenant pays their proportional share of the operating expenses and the property taxes. In apartments, you pay your monthly rent, that's what you pay. The landlord is responsible for the property taxes and the operating expenses. So when you have your rents capped because of rent controls, and you have an inflation environment where expenses are growing, that's not a good recipe. So our focus in apartments is in one of your backyard names, Boardwalk, which we helped create in the former career in the 90s. 52% of their NOI is the province of Alberta. You add in Saskatchewan, it's over 70%. Everybody knows about the population employment growth in Canada. As you guys know, the population migration to Alberta last year was a record. Looks pretty good, looks pretty cheap. Notwithstanding, I think it was the best performing REIT in Canada last year. We still like it. So that's our core, really significant long. We're short in the United States. I didn't mention another reason. You have 1 million apartments. under construction in the United States. 1 million. What does that mean? 1 million sounds like a big number, a small number, I don't know, but it's the most we've had in 50 years. So we're cautious in apartments. Talking for a while, I don't know if there's any questions, but Jeff, Dave, Raheem, if there's something you want us to talk about specifically or address any questions, fire away.
Yeah, just for everyone in the audience, there is this Q&A button in there. If you do
I
have,
drove it till it was falling apart, right?
please type it in there, and we'll answer on your behalf. And Raheem, you have any initial questions?
Hey guys, just a quick one here. Like the analogy of Vision being the farm team to American private equity or takeout funds. Longer term, what are the themes that you like that are not so observant? Multifamily is one, data centers, but is there something emerging under the surface that you guys are kind of watching and keeping your eye on? We have a lot of sophisticated investors right now on the line. And, the thing that I like about Vision, it's a little bit more cutting edge in terms of trying to go where the themes are that are going to be uncovered rather than vanilla chasing or index chasing. So is there something that, you guys have pinpointed yourself or for Andrew, Darren, that, you think, hey, 3 to 5 years out, we're going to start to really look at this aspect of real estate. We think it's in the early days. Does anything come to mind?
Good question, a tough question. I guess I'd frame it partially, and Darren and Brett might be able to prompt me some of the things we talk about internally, but it starts with supply and demand, really. I learned in my first job that rents are meaningless. So you see over Darren's shoulder there, you see the picture of a 72-story office tower in downtown Dallas, Texas. The reason that's there, in my first job at a grad school in Chicago in the 80s, I started with a public company in Canada called Bramley, and we were building that tower in the late 80s. Now I was a junior guy responsible for the pro forma of that tower. And that building, which was 2.2 million square feet, the 10th largest, tallest building in the world at the time, was 85% leased 2 years out. But if you were a broker and you put a full floor tenant in that building, my company put a Cadillac in your driveway. You leased so many square feet in that office building, you got invited on Alaska fishing trip with the chairman and CEO of Brownlee Limited. After 2 years, I looked at my pro forma, and we had 11 lines of tenant inducements. Any way we could get that building leased, we did it. And we'd given away the equivalent of 4.5 years of free rent on a 10-year lease. So I learned in my first job, rents are meaningless. You can make rents whatever you want them to be. How many Cadillacs, how many fishing trips, how much free rent, how much tenant improvement dollars are you going to give to tenants? And so where does this come from? I mean, firstly, let's finish this tale. It's hard to get this information because the REITs publish rent, and you see these charts and these presentations. Our average rent, I mean, you guys will remember our largest short position we ever had was our short position starting in 2013, including in 2017 of Dream Office REIT. And it was driven partially by supply and demand. They had too many office buildings in Calgary, in Toronto, and the CEO would get on the conference call and he'd say, we have 1.5 million square feet of lease expiries coming up, but don't worry. Our weighted average in-place rent is $15.10. And market rent is $16.50. And analysts are writing this down. Oh, $16.50, $15.10, that's pretty good. What he wasn't telling them was he was giving 6 to 9 months free rent and writing a check for $60, $70 a square foot the day that tenant came in, and net effective rents were less than $10. And so you got it. I mean, relationships where you find the actual lease deals. You don't necessarily always find the name of the tenant. It's helpful. In the US, disclosure is better. In Canada, it's terrible. You got to be in the weeds to find this disclosure. So supply and demand is the key. In that case, we were looking out at Calgary and we were seeing too many office buildings being built. And these days, supply and demand, to your comment about looking forward, has some depends on the sector, is really the key to our strategy. And before we have a portfolio meeting, we spent 2 days going through supply and demand by property type, by geographic region. And a lot of that is 2-3 years out. When we say we're looking at discounts and net asset value, it's not based on a cap rate today. It's based on our forward-looking view of value based on supply and demand.
I think Raheem, to
I
your
know.
point, to your point is, I doubt,
We should have
doubt-
news here pretty quick.
I doubt very many of the viewers actually appreciate or knew that there were 16 different sectors within publicly traded real estate security equities that we can invest in. But then also within these sectors, which is a $2.3 trillion universe and 300 names in North America, you have subsectors. So you think of office, subsectors to office that we invest in, and maybe Jeff, you want to discuss as far as our positioning. People don't think about medical office. They don't think about lab space. So, these are other sectors that, don't hit people's radar, but have been in our universe. And because this is all we've done for 15 years, we know them all.
One of the trends, you're coming back to your question, which Darren prompted, we don't think office space. I mean, we're very negative on office. I've never seen anybody in history make money with a buy and hold strategy in office. You can't do it. You can buy it 88% occupied, lease it up to 95 and sell it and make good money. But to sit there year after year after year and think and get a reasonable return with a hold strategy in office is very difficult. And the principal reason we've already talked about are capital expenditures. And it's not the lobby renovation or the parking garage, it's the tenants. Every time you lease that space, you got to give them free rent, tenant improvement dollars. So office is a tough space, but office isn't dead. We think there's a 15% long-term reduction in demand from office from the pandemic, work from home, longer-term trends. But what is key in office, back to your question, it's a bifurcation in office. If you want your employees to come back to work, you better have the most modern, most highly amenitized, most environmentally friendly, best mechanical systems, well-located, more sexy space. And so we see a bifurcation in the office business today, where buildings built 2015 and newer, there's a strong interest in them. Buildings built 2015 before, no, you hear a big sucking sound from tenants leaving those buildings. So New York City, Hudson Yards on the west side, getting over $200 square foot. SL Green, One Vanderbilt, connected to Grand Central Station, brand new, great space, over $200 square foot. But some of those older buildings on Park Avenue, they've been around for 60, 70, 80 years. They're really seeing a lot of vacancy. So you're seeing bifurcation within markets as well.
There was a question, Jeff, I think we're probably going to ask it, but there was a question from one of the participants, your view on self-storage.
It's a bit bifurcated. We like Canada better than the United States. In the United States, there's 8 square feet per capita self-storage space. In Canada, 3.5. Now 3.5 is not going to 8. There are reasons for that. US, South US, a lot of homes don't have basements. Americans tend to move around more than Canadians. But we think 3.5 can go to 4.5, 5. So fundamentally, that's good. Currently, the United States rents really went crazy in self-storage. and now they're coming off. So we're actually short self-storage in the US. In Canada, we like the business. There's really only one name, Storage Vault. And it has amongst the worst governance I've seen in my career. So good people, smart people, they're really good stewards, but they're just not sufficiently aligned. They have a private vehicle and a public vehicle. So they do a good job. They're well positioned. It's not that liquid. It was a highly promoted growth story, did very well. But in our view, it's very hard for Americans to buy the stock because of the governance. So we're not sure who the marginal buyer is, but you know, at the right price, that's a good name.
One of the things that that we're attracted to is the short side of what you do, and partly because the behavioral aspect, you never get too tied to loving the sector, so to speak, like we see time and time again. Can you touch on some of your bigger short positions that have been successes, how they came about, and why there's such a difference with your background and looking on the public side and the other
Sure.
incentives created to be able to exploit that?
So your question prompts, I think, a number of things that would be useful to explain. First of all, most of our short positions are part of long, short-haired trades, where the attribution of the performance needs to look at both sides. So, for example, we had one trade, you guys remember these names, 10 years ago? The same trade 3 times in 18 months. We were long H&R REIT, and we were short CREIT, which is now Choice REIT. One time they both went up in price, and we made money because the long went up more than the short went up. One time they both went down in price, and we made money because the long went down less than the short went down. And one time was a perfect world. The long went up and the short went down, and we made money on both sides. Now, we could have lost money if relatively the long went down and the short went up. I don't think that's happened once in 16 years. And so that is key, where we're looking at relative value. We might be long an office REIT in New York City and short an office REIT with exposure in Los Angeles, thinking New York's going to do better relatively than Los Angeles. So that's typically how we use our short positions. Now, we do employ selectively what we call alpha shorts, where they're not designed to be paired, and they can be on a sector or a cross-sector basis. And I mentioned Dream Office REIT, so I'll just pick up that case study, if you will. So that was driven by a couple things. One, I already touched on. There was 2013, we looked out, we saw 7 million square feet of new office space being built in Toronto, and 5 million square feet of new office space under construction in Calgary and Edmonton. We saw negative demand, negative leasing in both markets 2013. Marginally positive 14. 15 was a bloodbath. I don't have to tell this audience about 2016 in Calgary and Edmonton, Alberta. It wasn't pretty. And Dream Office REIT at the time had 45% of its net operating income from Class B office space in Toronto and 27% of its net operating income from Class B office space in Calgary and Edmonton, Alberta. This, in our experience, having lived through the 1990s, was an accident waiting to happen. Too much supply, less demand, not a pretty picture. But the second factor, and one of the other factors we use in Vision, is governance. This REIT had, as we were described in the financial press at the time, you can see this on our website under the media tab, the quote, most egregious external asset management contract we'd seen in our careers, where they pay an external asset manager controlled by the REIT CEO, asset management fees, property management fees, acquisition fees, disposition fees, financing fees, leasing fees, construction management fees, and 15% of the cash flow. And because of this contract, this REIT was incented and aligned to grow. not grow profitably, but grow, and grow they did. They bought $3 billion of REITs, real estate, properties, over a 3-year period. But in doing that, they paid Canadian investment dealers hundreds of millions of dollars of fees in their realty brokerage departments, in their equity underwriting departments, in their debt capital markets departments. So every analyst in the country covered it. Everybody covered it. It was a gift that kept giving, every Christmas bonus. So none of the analysts wanted to be the first to put up his or her hand and say, sell Dream Office REIT, short Dream Office REIT. And we were short initially 3 years. And the stock went from 33 to 14. And over that period of time, every analyst in the country had a buy recommendation on the stock. 33 to 14, it was a buy all the way down. And we covered 90% of it in December 2015, thinking maximum pressure with tax loss selling season. It did drift a little bit lower. We thought the next pin to drop is that the REIT must cut their distribution. The Ontario Securities Commission quietly sanctioned 40% of the REIT sector earlier in 2015 for misrepresenting their payout. We didn't think they'd want to face that music again. We thought they'd hang longer than they did, but February 16, another press release, we said they're going to monetize the, before that, they monetized the value in the external management contract and gave the company controlled by the REIT CEO 4.85 million units of the REIT, or 4.5% of the capitalization of the REIT, was gone overnight for no additional consideration. So that was the first reason that this thing really worked. And the second reason is they announced in February 16 that they were cutting the distribution, and they had a new business plan. The analysts ignored the cut in distribution, and they focused on the new business plan, which was just putting little yellow sticky notes in our office buildings. They redefined it into strategic assets and core assets. And the stock ran again from 16 to 21. We shorted it again. And in August of that year, they announced a $750 million write-down on the Alberta portfolio, which they subsequently sold. And we covered our short at that period of time. So that's a little bit about how, or a lot about how we use our short positions. Today, we're short some of the nursing homes in the United States. Some of the valuations of these names are anticipating its 2019 occupancy. Occupancy has been slow to recover. Labor, this sector lost 20% of their labor force in the pandemic. They've been slow to come back. They've been getting them back. It's more expensive. Labor costs are gone up. As a result, they're using a lot of agency labor, which costs 4 times as much as their own labor. So that's one sector. We're cautious on hotels. We're cautious on malls. But our biggest short today, it is yellow, not red, because we're long healthcare in Canada and short in the United States. And we're short apartments in the United States.
Well, I just, in courtesy of your guys' own time and the other people joining us on the call, for any participants, feel free to reach out to Dave, Raheem, or myself. More than happy to get any of your questions answered or touch upon them ourselves. Jeff, Darren, thank you very much for your time. We really appreciate you guys spending the time kind of working through your portfolio. It's had a meaningful impact for our clients, so we really do appreciate it. And with that, we'll chat soon.
Much appreciated.
Take care, guys.
Thanks.